So one of the reasons that the supply and demand curve is always taught in principles of microeconomics is because it's a really useful model, even though it may not always depict reality completely. And one thing that it is really good at doing is thinking about how prices and quantities will change when something happens to a market, right? And we usually call these exogenous shocks. Exogenous just means that it's something outside of the model, which is almost everything, because the only thing we have in the model is price on the vertical axis and quantity on the horizontal axis. And so if something changes, whether that means tastes change, something becomes more popular or less popular, technology changes, trade changes, whatever it is that changes, we can think about how that's going to shift the supply and demand curves, and therefore how that's going to change the price and or quantity. So one possibility, for example, is to think about an improved technology. And so basically an improved technology simply means that we can create more of the good with the same amount of inputs. Or produce the same amount of the good with less inputs. So improved baking technology in our example here with loaves of bread on the horizontal axis and price on the vertical axis means that the supply curve will shift down and or to the right, meaning that at any price, firms will be willing to produce more. And that's because the marginal cost will have fallen, right? And that means assuming that demand stays the same, and remember that demand comes from consumers, so that's the willingness to pay, then we will move along the demand curve, in this case from point A to point B, and we will get a fall in price and an increase in quantity, right? And this is really the biggest thing that has been driving the hockey stick of increased productivity, increased consumption, increased output that we identified in chapter one, has been an increase in technology, right? Being able to do more with the same amount of inputs, being able to, figure out how to use fire, being able to figure out how to use the steam engine, being able to figure out how to use electricity, nuclear power. All of those are increases in technology that have increased the supply curve, reduced prices, and increased quantity. So that's really a useful piece. We can also see, that what would happen with increase in demand, a decrease in demand. And so it's a very useful model because even though it probably won't tell us exactly what the fall in price and increase in quantity is, we can tell the direction that price and quantity will go. Market entry is another way that the supply curve will increase, right? And so if more firms enter the market, then supply increases. That means that price goes down, quantity goes up. And why might supply increase? Well, there could be a number of reasons. One could be that existing firms were earning some economic rent, some positive economic profits. And as long as the cost of entry aren't too high, which presumably they wouldn't be in, something like baking loaves of bread, then other firms may enter the market, and then we would expect economic profits to go down to zero, right? And remember, that could mean that they're still earning accounting profits, because accounting profits don't take into account the opportunity cost of that capital. But you could use that capital to make the same profit in, another competitive industry. Um, a market where entry costs would be very high would be something like making airplanes, right? So really, there's really two main, especially jumbo jet manufacturers and Boeing and Airbus, and they're probably earning positive economic profits, but there's not a lot of competition because the costs are so high. Although we do see, there's a firm in China that's starting up, partially driven by China's concern, to provide some national option outside of the United States and Europe. The other useful thing that we can do with the market supply and demand model is to think about taxes, right? And one type of tax is something like an excise tax, where you tax each unit of an item that's sold. So the closest we sort of come to that in everyday experience is with sales taxes, which many states have, even some cities have. And the way we can think about that is that it changes, in this case, the supply curve. You can actually draw the same thing with a new demand curve. It doesn't really matter which way you do it. But in this case, so we were at P star at point A and Q star, and then we put a tax on, and the tax is equal to P1 minus P0. But what you can see here is that whether or not the tax is paid by the consumer or by the firm, who actually pays the tax depends on the elasticity. So we'll talk about that in a minute. But the consumer price in this case goes up to P1, which is not P star plus the tax, and the seller price goes down to P0, which is not the P star minus the tax, but the tax is really shared. And so what we see is that the consumer surplus falls, right? It used to be this whole triangle above P star and under the demand curve. Now it's from point B, so it's above P1 and under the demand curve. Producer surplus falls, right? Now it's below P0 and above the supply curve. And now we have this new shape, this green rectangle. And that green rectangle is the tax revenue that the government gets. And so that's equal to however much is sold, Q1, right? We sell less because of the higher price, times the actual amount of the tax. But because we're selling less, right, we have created a deadweight loss, and that's this white triangle. So if we think about the welfare effects, uh, which is really important when you're putting in a tax, it's going to depend on how elastic the demand curve and supply curve are. So if the demand curve is very inelastic, so that could be because it's a necessity, it could be because it's addictive, like cigarettes or alcohol, then consumers will be the ones that pay most of the tax. On the other hand, if it's very elastic, because there are a lot of substitutes available, and supply, for instance, is inelastic, then the firms will be the ones who pay more of the tax. And that's what's called the tax incidence. And it just depends on the relative elasticity of the supply and demand curves. Just think that the more inelastic curve bears more of the tax incidence. So if demand is more inelastic, consumers bear more of the tax incidence. If supply is more inelastic, firms bear more of the tax incidence. And from the government's perspective, they want to tax things that are very inelastic. And the reason for that is if you imagine both an inelastic supply curve and an inelastic demand curve, then the tax revenue that you can raise will be higher and the deadweight loss will be lower. And so that's why, a lot of goods are taxed, so-called sin taxes. So, alcohol and cigarettes are taxed, and there's sort of a dual benefit there. One is that their demand elasticity is very inelastic, and so there's less of a deadweight loss, and also it encourages people to drink less and smoke less, which has positive health benefits. So here's one example of a sin tax, was in Denmark in 2011. They introduced a tax on saturated fat. And so that affected obviously butter, which is basically all saturated fat. And it was equivalent to 22% of the average butter price. And so we can model that with our model of supply and demand by going from point A to point B. This is the tax. You can see that the supply curve is very elastic, right? Meaning it's very flat. And the demand curve is less elastic, although still kind of elastic. And consumption of butter and the related products fell by 15 to 20%. And so that was really the goal of the tax, right? The goal of the tax was to get people to eat less saturated fat, in which case it was successful, although Denmark eventually decided to remove it because of the administrative burden of collecting it. But we have seen a number of cities put a tax on, for instance, sugary drinks, right? So sugary drinks are one of the causes of obesity. Obesity is one of the major health problems in the United States. And so the argument is, well, if we put a tax on sugary drinks, people will drink less of them. That will help reduce obesity. That will help save costs. Um, and so we see this throughout history, governments trying to both raise revenue, but also try to encourage behavior to be healthier, whether that's with alcohol, cigarettes, or sugar, or in this case, fat.